earnings, we denote it as D. So retained earnings, we denote it as KR, cost of retained earnings, KR. So KR, the formula is DO 1 plus G over PO plus G. So you need to know this. These formulas, you must master them. DO or D1 PO plus G. DO 1 plus G. So DO stands for the most recent dividend. This one stands for the most recent dividend. DO stands for the most recent dividend. G stands for growth rates. It is already indicated in your handouts. And then PO stands for the market price per share. PO stands for the market price per share. G stands for growth rate. Ordinarily, we're supposed to use the future dividend. D1 is the future dividend. So where the question has given you, so how do you compute D1? D1 here is equals to DO 1 plus G. So in other words, if you've been given the recent dividend, the reason that already been paid, you need to compute for the future dividend by taking that past dividend or the recent dividend, then you add 1 plus G in order to get the future dividend. Are we together? So you're supposed to use future dividends. So you check the question. Some question will just give you the future dividend, the expected dividends. So you will not use this formula. You just take that future dividend. If you've been given the last dividend to be paid or the past dividend, then you need to compute the future dividend by DO 1 plus G. So this is how you compute the cost of retained earnings. This is how you need to master that formula, cost of retained earnings. And then number 2, we have the cost of equity. We write KE, cost of equity. It is computed the same way as cost of retained earnings. They are the same, except now for equity, we have what we call the flotation cost. Remember equity, the cost of equity, we have to issue shares in the market. And then on issuing shares, sometimes you get what we call the flotation cost. Flotation, these are the costs of issuing shares in the market. So the retained earnings do not have F, but the retained earnings don't have F because these are already funds available, isn't it? And then this one sometimes have F. So this is the cost of equity. So the first thing here, you need to master the formulas. Already you have done 2, isn't it? Another thing now, when you're computing these 2 items, some questions will require you to determine G, to determine this G. So there are 2 ways in which you can determine G. There's what we call compounding method. So determination of G, there's what we call compounding method. Compounding method, which is given as this. dn over do minus 1n. So you'll be given the earnings or the dividends as they're growing year by year. So you'll be given a list of dividends for many years, which indicates growth rate. So dn is the current dividend. Then do is the previous dividend, the first dividend. In other words, the list of the years of dividends you've been given. Then n is the number of years minus 1. Then minus 1. So this is a compounding method, or we have what we call the retention ratio. Retention ratio method. This one is RB. RB meaning we have the retention, that proportion, that percentage of the retained earning that is retained. And then you multiply by the cost of equity. You multiply by the cost of equity. So this is the only thing you need to know under cost of equity and retained earnings. So you know the formula, and some questions will require you to compute the growth rate. So you have 2 methods of computing the growth rate. Number 1 is the compounding method, where you have the recent dividend, which is denoted as dn, and the previous dividend do. Then this one is outside the square root, the nth root here. Then this n is the latest dividend, the number of years minus 1. We're going to see them in a question. Then number 3 is the cost of preference shares. The cost of preference shares, KP. That is the initial cost of preference shares. One is dividend over VP minus sometimes F, not always, minus sometimes F. Dividend means These are the dividend paid to preference shareholders, dividend per share, and then this is a market price per share. Where you've not been given the market price per share, then the par value is the same as the market price. In some other question, they will not give you the market price, but you just be given the par value. So the par value will act as the market price. And then this is the flotation cost. Not all questions are flotation cost. So this is how we determine these initials. You can use the initial that you like, but it's provided that you come up with the same figures. So that is the cost of preference shares. And then number 4, we have the cost of debt. We call it KD. So KD, we have 2 kinds of debt. Cost of debentures, stock bonds. When you check your handouts, you go to the cost of debentures, stock bonds, stock debt. So debentures, according to what we have, can be classified into 2. We have irredeemable debentures. So we have 2 kinds of debentures. We have irredeemable debentures. So these are debentures with no maturity period. So you've been given loan and you've not been given a definite period which the loan is supposed to be redeemed. So you have the money perpetually. So irredeemable debentures. So how do you determine this kind of debt? So this one is equals to the interest that you're paying on the debenture, and then VD. This is market. The VD is the current value or the book value. VD is the current value or the book value, and then it must be net of tax. It must be net of tax 1 minus T. KD is equal to interest over VD 1 minus T. So this is how you determine the cost of equity where the debt or the debenture is irredeemable. Irredeemable means it has no definite maturity period. In case we have flotation cost, you must also deduct flotation cost here. In case we have flotation cost, T stands for tax. In other words, this cost must be determined net of tax. T stands for tax. So that is the formula for KD. That is cost of debt irredeemable. Irredeemable meaning it has no maturity period. Then we have KD redeemable. KD. And then when you're computing the interest here, when you're determining the interest, you determine it based on the par value. The par value of the par value means the book value. So interest is determined based on the par value, not the market value. VD. VD is the value. Then we have redeemable, KD redeemable here. KD redeemable. Redeemable means it has a definite period of maturity. Sometimes they call it yield to maturity. Yield to maturity. So sometimes they call it yield to maturity. So this one, the formula is interest. We have interest plus in bracket MV, that is market value, VD, that is par value, over MV plus VD, you multiply by a half, and then this is 1 over N. 1 over N, then 1 minus T. So this is MV, this is the par value. This is the par value or the book value. Par value stroke book value. And this one is a market value. This is a market value. N is a period to maturity. Period to maturity. T is the tax rate. So once you know those formulas, then you are halfway through this topic. Halfway through the topics. So you must master the formula first. And you're saying these are the formulas, these are the component cost of capital. Then after that, you need to know how to compute the weighted average cost of capital and then the weighted marginal cost of capital. So once you know how to compute these two, once you know how to master the formulas, the next thing is to know how to compute weighted average cost of capital. weighted average cost of capital. Weighted average cost of capital. Sometimes we call it WACC. So this is the combined cost of the weighted average. This is a combined cost. This is the overall cost of the cost of capital, combined cost. So the question will either ask you this or weighted marginal cost of capital. Weighted marginal cost of capital. Sometimes we call it WMCC. So that is the first aspect of this topic. At the end of it all, when you open your question papers, you realize that in every sitting, you either be tested on this or this. And for you to be able to do a question on this and this, first of all, you must master the topics, the formulas. And then now you know how to combine them. So we can best do them in a question. Before we look at the break point. So maybe, I don't know whether you have this question, May 2014 question 4B. 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 May 2014 question number 4B, cost of capital. So remember, these questions are tested in each and every sitting. May 2014 question 4B. So the question reads, the following is the capital structure of Ngana Limited. So you've been given the capital structure. So ordinary shares in bracket 100. And then we have 80 million. We have preference share capital. And then we have 35 million, and debentures 27 million. Additional information. The shareholders of Ngana Limited expect earnings and dividend to grow at a constant rate of 5% in the future. The company has just paid a dividend of 4 shillings per share. The current market price of ordinary shares of Ngana Limited is 80 shillings. Number 3, treasury bonds yield 12%. The return on the market is 14%. The company beta is 1.5. Number 4, new preference shares can be sold at 120 shillings per share with a dividend of shillings 12 per share and the flotation cost of 6 shillings per share. Number 5, the corporation tax rate is 30%. In number 6, the company pays all its earnings as dividends. Number 7, the company will sell 12% debenture with a maturity of 10 years at 90 per debenture. The par value of the debenture is 100 shillings. Required, using market values, calculate the weighted average cost of capital of Ngana Limited. So they want us to compute the WACC. That is, so now the steps you take in order to compute the weighted average cost of capital. Step number 1, you determine the cost of individual component, the cost of individual. And then when you're doing cost of capital, you exclude retained earnings. You exclude the cost of retained. So you start with the cost of equity. We say it KE. That is the initial for cost of equity. So when you're computing the cost of equity, first of all, you check the kind of dividend given. Is it future dividend or past dividend? That is the first thing you check. So in this question, the dividend that is provided, you've been told the company has just paid a dividend of 4 shillings. It means that is past dividend. So it is not a future dividend. So the formula to use in this case to be DO 1 plus G over PO. You also check whether you have flotation cost in the question. Not all questions have flotation cost. In this question, we don't have flotation cost plus G. Tumeelewana? So what is our DO is 4. Is it 4? Plus 1 plus G. The growth rate is how much? The growth rate is it 5% or 6? The growth rate is 6%. Is it 5%? 5%, isn't it? So the growth rate is 0.05 over the market price per share. How much? The market price per share is 80 plus 0.05. Of course, this answer you multiply by 100. So what do you get when you do that computation? $7.10. Are you sure? 10.2? So 10.25%. So that is the cost of equity. That is the cost of equity. And then number 2, you go and compute the cost of preference shares. Cost of preference shares. We said it's dividend over VD minus F in case it is there, multiplied by 100. So in this question, the dividend, the preference dividend, how much is it? So the dividend is computed. We are told in note number 4, the new preference shares are sold at 120 per share with a dividend 12 per share. So we have been given the dividend per share. So this one is dividend per share, which is 12. And then it's being VD is the market price, which is 120. It has a flotation cost of 6, right, by 100. So what do you get? $10.5%. So that is the cost of preference shares. And then number 3, we compute the cost of debt. That is the cost of debentures. So we check the kind of debentures that are given. Are they irredeemable or redeemable? So redeemables, you'll be able to distinguish them by the maturity period provided. If they have given you the maturity period, then it means it is redeemable. If there's no anywhere you can see the period of maturity, then that one is irredeemable. So in this one, the company will sell 12% debentures with a maturity period of 10 years. So that one we said it is interest plus 1 over n, or the n can be on the other side. And then we said MD VD over a half in bracket MD plus VD, and then 1 minus T. 1 minus T. So interest, we said it's based on the par value of the debenture. The interest is based on the par value of the debenture. So the company will sell 12% debenture with a maturity period of 10 years and 90 debenture. The par value of the debenture is 100. So interest will be 12% of 100. That is the interest. And then plus 1 over the maturity period is 10 years. In bracket, MD, we said it is, what is MD? The MD is the par value, is it? The par value, this one, which is 100. And then the market value is 90. And then over a half in bracket 100 plus 90. And then this one, 1 minus 0.3 Tax rate is 0.3. So we always use this formula if the question has given us the maturity period. Are we together? If the question has not given us the maturity period, then it's very easy. Just interest over the market price. So you're unapata ngapi? So you do the numerator first, and then you do the denominator, and then you divide. Sorry? 8.8. 9.6 or 8.8? 9? So 9.6. So hiyo ndio step ya kwanza unafanya. This is the first step you determine. When you are computing work, you determine first of all the cost of the component cost. The component of capital. You determine the cost of the component of capital. And then here you determine, when you're using, we determine the market values. We determine here the market values. Determine the market value of the component cost. The market values. For instance, here we have the market values, ordinary share capital. Ordinary share capital. What is the market value? Currently, okay, we can say this one shillings and thousands. Shillings and thousands. So one share is equivalent to 100 shillings. What about 80,000 shares? 80,000 value of shares. How many shares will that be? So this one is going to be 80,000. You divide by 100 to know the number of shares. And then at the market currently, each share is sold at how much? At 80. So we divide this one by 100. This is the par value of one share. We divide this one by 100 in order to determine the number of shares. And then we convert them into market value. The market price per share is 80. So that one is the market price. How much is that be? So this one will be 64,000. So that is number one. And then we have preference share capital. Preference share capital. The market value. Each share is valued at 100 the same. And the total value is 35,000. So 35,000, you divide by 100 to determine the number of shares. And then you multiply by the market price per share. So the new preference shares, the market price is 12 shillings minus 6, which is 60. The new preference shares can be sold at 120 per share, isn't it? With a dividend of 12 per share, flotation cost of 6. So 12 minus 120 minus 6 is how much? 114. So the price is 120, but you take care of the flotation cost. You deduct flotation cost. So the value, how much? 49,000. 39,100. So that will be the market value. And then here we have the debentures. So debentures, we have been told one debenture is equivalent to 100. So 27,000, you divide by 100, and then the market value is how much? 90. It can be sold at 90. So inakuja ngapi? 24,300. So now you come here and determine the weighted average cost of capital. Weighted average cost of capital. So here you say the source. You can use this formula, the source, and then the value, Then here we have the proportion. And then here you cost. Then here cost times proportion. So the first one is ordinary share capital. The value is 64,000. And then we have preference share capital. The value is 39,900. And then we have the debentures. The value is 24,300. And then you add all this. When you add all them, when you aggregate them, what do you get? $128,200. So you take 64, you divide by 128,200. What do you get? $0.5. 0.499. Okay, the other one, 39,900 divided by 128,200. Sorry? 0.3. So this one will be 0.311. And then there's another one. Zero point 0.81189. And then you just write the cost of capital. For ordinary share, it was 10.25. So right here, cost 10.25. For preference shares, it was 10.5. And then for debt was 9.6. Then you multiply this one times this. 0.499 times 10.25. What would be the answer? 5.11. Sawa? Na hiyo ingine? Sorry? 3.26. And then the next one? 1.8. 1.82. And then now you aggregate them, you add them together. That one will be your weighted average cost of capital. %. So that is how it's determined. In the notes that you are using here, you can see, or this, you can use this formula, or we have what we call, you can determine weighted average capital by saying, this is weight of equity and then cost of equity. Weight of equity, cost of equity, plus weight of preference shares, cost of preference, plus weight of debt, plus KD, 1 minus T. Of course, you've already computed this one less of tax, isn't it? So that one is how you can use it. So you can say here, this one is the value here, you can say it is the value, already you have determined, so it's going to be 64. We use the over 128.2. Tumeelewana? This is the weight. The weight of ordinary shares, 64 million, isn't it? And then the value, that is the total, isn't it? That is the proportion. This is the weight. This is the weight. And the cost is how much? Times 10 point plus, ile ingine itakuwa ngapi? 39.9 over 128.22 times 10 point plus, the other one is 24.3 over 128.2 times 9.6. So that is another part of most of the notes we're using this one, isn't it? But some students also, when you use this one, they understand more, isn't it? Which one is easier for you? First one is easier. Okay. So you can use the first one, isn't it? This So remember, the things to remember when you're computing the weighted average cost of capital work, you don't include the cost of retained earnings, number one. And then number two, you use the market value weights. The market value, not the book value. The book, unless the question has instructed you to use the book values. If the question had given us the option to use the book values, the book value as indicated in the question, that is the book. So, but work, weighted average cost of capital, use the market value. So, you can take a photo of that, or you can write it down before we look at another question and another one. We're being asked here by one of us, where have we used note number three? Note number three, isn't it? Can you see note number three? So note number three says, so it says treasury bonds yield 12%. Sometimes we can, if you're given this, you can, this one you learn it in section 5. We can use what we call the capital market line to determine the cost of equity. We say CAPEM, but no, you learn about it in detail in section 5. So the formula is RF plus beta, RF minus RM. So RF is a risk-free interest rate, which is represented by treasury bonds or treasury bills. Risk-free interest rate, it means it doesn't have any risks. Those ones that are issued by government. So once you just need to know the formula for now, but you'll know it in details in section 5. But in the meantime, should it appear in a question, this is the formula you use. RF plus beta plus, although it can give a different answer from the other formula. So for instance, here now, RF is how much? The RF is 12%, isn't it? The RF is 12%. Eh? Beta is how much? 1.50, isn't it? I think this one should be the opposite. RM minus RF. So RM is how much? 14 minus 12. So this is the formula. In case it appears and you don't have these other variables that you can use to compute the cost of equity, you can just use this formula. So if you use this one, you don't also use the other one. You can use one. So now when you do that computation, what do you get? So these ones are some variables that you can also use to compute the cost of equity. We call it CAPEM, Capital Asset Pricing Model. So learn about it. It is not an item in your, it's not an item in your syllabus. Tumeelewana? So tunataka tuangalie, that is how we compute the weighted average cost of capital. Before we look at another question of weighted average cost of capital, I want us to also determine one on marginal cost of. What is the difference between weighted average and marginal cost? Marginal cost is the combined cost of raising new funds. Is the combined cost of raising new funds for a new project. So the difference between weighted average is the combined cost of the current funds, while marginal cost of capital is the combined cost of the new funds. If you are raising new funds, then you need to determine the combined cost, while this one is the combined cost of the existing funds, So we have the differences they are given there in the handout. You'll check the differences. So I want us to look at a question that was done. I don't know whether you have it. December 2009. Can we check December 2009? December 2009, question number 2. December 2009, question number 2. December 2009, question number 2. You have that question? Mukonayo. So December 2009, question number 2. So December 2009, question number 2. The question reads, the capital structure of Jamal Limited, which is considered optimal as at 30 September 2009, was as follows. So we've been given the market value of the capital structure. So we have ordinary share capital, retained earnings, 8% preference share capital, and then 12% debentures. The company intends to raise additional funds for investment in a new project, which is estimated to cost 240 million. I repeat that sentence. The company intends to raise additional funds for investing in a new project, which is estimated to cost 240 million. Additional information, number 1, any new ordinary shares issued will incur a 12% flotation cost per share. The most recent ordinary dividend per share is 5 shillings per share. The past and expected future earnings growth rate is 10%. The earning growth rate is expected to be matched with the growth rate in dividends. The current dividend yield is 6.2. The current dividend yield is 6.25%. The company expects to raise a maximum of 36 million from retained earnings to finance the project. Additional 8% preference shares can be issued at the current market price of 80 per share. So required. Where is the required? Yours has required. What is the required? Number 7, where is it? Mine seems to be. Huh? Can somebody read for us number 7 and then the requirement?
Through the stock exchange. Corporate tax is 30%. The current market price per ordinary share. Number of ordinary shares that should be issued to finance the project, and the company's rated marginal cost of capital.
So now, so they want us to determine the marginal cost of capital, isn't it? Marginal weighted cost of capital. So remember the difference between weighted average cost of capital and marginal cost of capital is that for the marginal, we are raising new funds, isn't it? So we want to determine the total value, the total cost of the raising new funds. So the procedure is the same. You determine the component cost of capital. Determine the component cost of capital, and this time round, you include the cost of retained earnings. Remember, when you're determining weighted average cost of capital, you don't include retained earnings. But when you're determining marginal cost of capital, you include retained earnings. So we have KR here. KR. So the formula for KR is, first of all, you check the kind of dividend given in the question, the kind of dividend. So the most recent dividend per share was 5, isn't it? The most recent per share was 5. So here it is DO 1 plus G over PO. This one doesn't have flotation cost, plus G. So you check if you have all these variables or these items in the question. Sorry? Yeah, that is preference shares. So sorry, that is common shares, equity shares. But this is the cost of retained earnings. This is the cost of retained earnings doesn't have flotation cost. Is it so? So the only thing we don't have for all these items is the market price per share. We have been given the dividend yield. What is the formula for dividend yield? Dividend yield is market price per share over. What is the formula for dividend yield? Dividend per share. Nani anaweza kumbuka? Dividend yield. What is the formula for dividend yield? Dividend per share. Market price per over dividend per. Is it so? It is opposite. Are you sure? It is a dividend per share over. So that is the dividend yield. So we want to determine the market price per share. We have been given the dividend yield, which is 0.0625, isn't it? Which is dividend per share, which is 5. Market price per share we don't have, isn't it? So this one will go with this one, market price per share. This one, market price per share. So this one will cancel each other. So we have 0.0625 MPS is equals to 5. And then we divide by 0.62, 0.0625, which is equals to, so the market price per share is 80. So now we determine the cost of KR. Dividend is 5, and then the 1 plus G. What is the growth rate? The growth rate is indicated in note number 3. The past and expected earnings growth rate is 0.1, isn't it? Over 80 plus 0.1. And then you multiply by 100. So what do you get? It is 7%. She's saying 7%. Is she correct? $16. It's not 7%. How many are saying 16? Who are saying, another person who is saying 7? No one. So it will be 16%, isn't it? And then we determine the cost of equity. Cost of equity is KE, which is DO 1 plus G over PO minus F plus G. So this is DO. Remember, we use DO when we have the past dividend. So DO is how much? 5 in bracket 1 plus 0.1 over 80. What is the flotation cost? 12 point. These are new shares that are being issued. 12% of 80 plus G. G is 0.1. And then you multiply by 100. So what do you get? Ngapi? 17 point. So this one will always be expensive to the other one. Are we together? Student number 3. Number 3, we have cost of preference shares, KP, which you're saying it's dividend over VD. Do you have flotation cost here? Times 100. Times 1. So we determine the cost of preference shares. So the preference shares we have been told additional 8% preference shares can be issued at the current market price of 80. So you take the dividend will be 8% of 100. So you determine dividend based on the par value of the share. Dividend determined based on the par value, which is 8%. The par value is 100. And then the market price per share is how much? 80. And then divide, you multiply by 100. Where you have not been given the market price, the par value is the same as the market price. So the dividend is determined based on the par value. So inakuja ngapi? 10%. And then we come here, the last one is number 4. We determine the cost of additional information number 6, ndio? So we determine, is there an issue? There's no issue, isn't it? So we go to determine the cost of debt, debenture, which is KD. So we check whether it is redeemable or irredeemable. Which kind of debenture is this one? Is this redeemable or irredeemable? We don't have maturity period, so it is redeemable. So here we say it is interest over VD, or is it VD or VD? 1 minus T. So interest is based on the par value. The par value ni ngapi? 12% of 100. The VD is how much? Sorry? Oh, it's 1,000, It's 1,000, You are right. So what is the market price? What is the market value of the debenture? 960. Addition, the current, sorry. Oh, this mine doesn't have numbers. So this is 960, 1 minus 0.3. What do you get? Sorry? So 8.75%. So that is the first step. Determine the cost of capital of the component capital elements. So hiyo ndio kitu ya kwanza. Then now here, you come here and determine individual contribution. Towards new capital. So now you want to know what will be the retained earning contributed towards the new capital. The new capital that they want is 240 million. So we want to know out of the 240 million, what is the retained earning contributing? Okay. So now here, another question you'll be given there is specifically they will specify to you, this is what this element is contributing. Like in this question, isn't it? So the total new capital in ngapi? 240 million, isn't it? So retained earnings in a contributing ngapi? Note number 5. Retained earnings in a contributing ngapi? 36,000, ndio? Inabakia ngapi? So it is remaining 204,000, isn't it? Now we are going to use the book value proportion to determine what other components are going to contribute towards the capital, isn't it? Unasema nini? Shida iko wapi? 36,000. Note number 5. The company expects to raise a maximum of 36 million from the retained earnings to finance the project. So these are shillings in thousand. So remember what they need to contribute. The new project requires 240 million. So retained earnings are going to contribute how much? 36 million. These are in thousands. These are in thousands. So maybe I put here in thousand, isn't it? So that you can know. So the remaining amount is how much? 4. So now that is the retained earnings. So now we get the proportion, the book value, the proportion of the other components as represented by their book value. So ordinary share is 360. So add 360,000 plus 120,000 plus 200,000. What do you get? Take 360 for ordinary share capital. That is the book value. And then the preference share is how much? 120. And the debentures is how much? 200. How much you get? 680. So the ordinary share capital is going to contribute 360. 300 over 6, 680 times 204,000. And then preference share capital is going to contribute 120,000 over 680 times 204,000. And then we have debentures. Debentures is going to contribute 200,000 over 680 times 204,000. So how much do you get for ordinary share capital? $108. So this one is going to be 108,000. The other one? 46. 36,000. And then the next one? 60. So 60. So now we are going to compute the weighted marginal cost of capital. So here we're going to write here source, value, proportion, cost times proportion. You get this way, isn't it? So the first one is retained earnings. I'm just writing RE. I hope you'll understand, isn't it? So the retained earnings, how much? 36,000. And then we have ordinary share capital, which is 108,000. Then we have preference share capital, which is 36,000. Then we have debentures. Debentures is how much? 60. Total should come to 240,000. So we get the proportion 36 divided by 240. 240. This is the total amount of capital that you are contributing, 240. So the ordinary shares will retain and will contribute 36. You kama tunapatana. Tuko salama. So inakuja 0.15. Next. 0.45. The other one 0.1, 0.15. The other one 0.2. And then now you take the cost. The cost here, the cost of ordinary cost of retained earnings is 16. The other one is 17.5. 8. The other one is 10. And the other one is 8.75. Then you multiply. Huh? 2.4. So this one is 2.4. 8 point. This one. 1. 1.5. And la? 0. And then weighted. This is you add all of them. Unapata ngapi? $12.0. So 12.09%. So the question also required us to determine the number of ordinary shares to be. The question also wanted us to do the number of ordinary shares. Yes. This one is 2.1. 2.18. So the total 14 flat. $14.09. 14.09%. Sasa sijui kama tunaona the difference between weighted average cost of capital na marginal weighted cost of. So this is the cost of raising new funds. So in other words, when you're computing a WMCC, you must have new funds. Then you must have the cost of capital of the component. Then you must determine how much each component is going to contribute towards the new funds. So you must have this new capital. If you're not been given the individual component, you use the proportion as provided in the books, the book value. Sasa unatumia proportion yao ya vitabu. So that is the difference between work and MCC. So this one you must have new funds. Sasa. So this question also required us to compute the number of ordinary shares to be issued. So the value of shares to be issued is 108. This is 108,000. And then the market price per share ilikuwa ngapi? 80 minus 12% of 80. So how many shares are going to issue? This is the total value of the shares to be issued towards the new funds, towards the new projects. Now they want us to determine the number of shares. So we take the value of shares, multiply, divide by the market price per share. So how much do you get? $15.34. 1534 shares. So they're going to issue 1534 shares. So you need to know those two things, how to compute weighted average cost of capital and weighted marginal cost of capital. Besides, there's something called break point. Before we look at other reinforcing questions on the two aspects. So let's look at the break point. So they can either test you on WACC or WMCC or the break point. So let's look at what we mean by break point. Oh, so you can first of all take that one before we look at the break point. Now, we want to know what we call breakpoint or critical point. So according to what you have, this is a point whereby a given source of funds is finished and the investor decides to go for the next expensive. So when you're financing your projects, you start with the most cheapest source. And then if that source, you have a project that is greater than the cheapest source, you go to the next expensive. So now you break, from the cheaper to the next cheaper, and in that order. So break point is usually computed as follows. So according to what is written here, this is a point whereby a given source of fund is finished and the investor decides to go for the next expensive source to fund. So breakpoint is computed as follows. So breakpoint. So breakpoint is the amount to raise. Breakpoint is equals to the amount to raise over the proportion of the source of fund, proportion of the source of the fund, the source of fund. So proportion of the source of funds. So we can look at the question. I think when we see the question, so September 2021, you can see September 2021, question number, September 2021, question number 5B. 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 So the question reads, the management of Biashara Limited are in the process of determining the optimal capital budget for the company for the year ending 31st December 2021. The following information is available. Number one, the profit after tax for the year ending 31st December 2021 is estimated to be 22,500,000 shillings. Number two, the retention ratio is 6%. Number three, the ordinary shares of the company are currently trading on the security exchange at 80 shillings per share. Number five, the annual growth rate in dividend. Number four, sorry, isn't it? Ordinary shareholders expect a dividend of 6 shillings per share for the year ending 31st December 2021. Number five, the annual growth rate in dividend is 6% per annum. Number six, flotation cost amounts to 8 shillings per share issued. Number seven, the company could issue unlimited number of 11% preference shares at 96 shillings per share. The par value is it 100? Number eight, the company could obtain a bank loan of 24 million at a pre-tax interest rate of 10% per annum. Thereafter, unlimited amount of bonds could be issued under the following terms: coupon interest rate of 12% per annum, par value of 1,000 shillings per bond, discount 30 shillings per bond, flotation cost of 20 shillings per bond, maturity period of 10 years. Number nine, the optimal capital structure of the company comprises 15% debt, 40% preference share capital, and 45% equity. Corporate tax rate is 30%. Required, Roman 1, the cost of capital of each source of finance available to Biashara Limited. So the first requirement here, they want us to compute the cost of capital for each source available to the company. So the cost of capital for each source available. So the first one is cost of retained earnings. Is it so? We have been told there are funds available, isn't it? Cost of retained earnings, KR. So we said when you compute the KR, what do you check? You check the kind of dividend that is given. So this dividend that is provided in this question, is it future dividend or past dividend? Let us read it again. The dividend that is given. Is it number 4? Ordinary shareholders expect. When you expect, that is a future dividend. So you write here D1 over PO plus G. That is the formula you use. So D1, the dividend they expect is how much? 6. We said here KR, when you compute the KR, we don't have flotation cost. So the market price per share is how much? The ordinary shares of the company, the ordinary shares, not number 3, is 80, isn't it? 80 plus G. What is G? 0.06, not number 1. 0.06, 6%, isn't it? So this is how you compute this one. So you multiply by 100. So unapata ngapi? Huh? 13.5. So this one is going to be 13.5%. And then now the next one is cost of equity, KE. So you're going to be D1 over PO minus F plus G. D1 is 6 over 80. What is the flotation cost? 8 shillings per share plus 0.06. And then you multiply by 100. So what do you get? So 14.3%. And then number 3. Number 3. Which other source do we have? We have preference shares. So KP, which we said it is dividend over VD minus flotation cost in case it exists. So what is the dividend? So we are being told in note number 7, the company could issue unlimited number of 11%. This is available to the company. 11% preference shares at 96 per share. The par value is how much? 100. So remember we say dividend is computed on the par value. So it's going to be 11% times 100 over 96 times. So nakuja ngapi? $11.45. 0.5. 0.65. Okay, 4.5. That is cost of preference. So this is a source that is available to the company. So we need to compute the cost. That is what the instruction. That is the instruction of the requirement of the question, isn't it? And then number 4, what other source is it? We have the bank loan, isn't it? So KD, we have KD loan. So the loan use what we call the coupon rate. The coupon rate is the interest, the agreeable interest rate by the banks. So when you go for the KD in form of loan, you just take the interest rate agreed. Ile me agree, si ndio? Hiyo ndio the cost of capital. Lakini sasa itakuwa interest 1 minus T. Tumeelewana? So the interest on the loan is how much? Pre-tax 12% in bracket 1 minus 0.3. Inakuja ngapi? Hii ndio cost wameagree, si ni kweli? So that one you take it directly. Inakuja ngapi? $0.0 times 100. 8 point. So that is the cost of KD. Then here we have what we call KD bond, KD. So the KD stands for bond and loan. So the bond, we are going to check the kind of bond we have or the debenture. So the bond we have here is redeemable. Ready? So we write the formula, which is interest plus 1 over n in bracket MD minus VD over a half MD plus VD, then 1 minus T. That is the formula. The redeemable, you check the maturity period of 10 years, not number 8. Maturity period of 10. So once you see the maturity period, then it is redeemable. So now we have we say MD is, what does MD stands for? What is MD standing for? Par value. Now VD, so the market value, isn't it? So the VD here, the VD you have been told in the question, the par value of the bond is 1,000, isn't it? So the VD is going to be 1,000 minus, you must give it a discount of how much? 30, and then you must give a what? Flotation cost of how much? 20. So the VD is going to be how much? 950. Sidio? So the interest is based on the par value. So the interest is how much? 12% of 1,000. Is it so? Plus 1 over the maturity period is how many years? 10. In bracket 1,000 minus 950 over a half in bracket 1,000 plus 950, and then here 1 minus 0.3. What are you? So umepata ngapi? Sorry? 8.9%. Wangapi wamepata kama hiyo? So those are 6 marks. So your ability to compute the individual, the cost of capital for the sources available to the company. Yes. You see, loan, you have agreed with the lender. You're going to be given a loan, and this is the rate of interest, isn't it? So that is the cost of capital. It was 11%. It was 10%. Oh, sorry. This was 10%. Eh? Oh, sorry. This is supposed to be 10%. So it's how much here? So this is 7%. Sorry for that. So this one is supposed to be 7. Tumeelewana? So kila mtu hapo nadhani anaweza compute the hizo ma costs, si kweli? Sasa hiyo no 6 marks. And then the break point is the marginal cost of capital schedule with respect to retained earnings and debt. And then they want the marginal cost of capital at each break, the break points. So we said the break point in retained earnings, the break point in retained. So we start here, break point in retained earnings. Breakpoint in retained earnings. So what is the value of the retained earnings? So retained earnings, they're going to retain how much? 60%. 60? So retained earnings is going to be, retained earnings is going to be 60% of 22,500,000, which is how much is that one? 60% of 22,500,000? 13,500,000. That is the break point. That is a retained earnings, isn't it? So break point, we said it is a retained earnings. So we have here retained earnings over proportion of retained earnings in capital structure. So proportion of retained earnings in the capital structure. So retained earnings is 13,500,000. The proportion of the retained earnings, which is represented by equity, is 0.4, 0.45. Inakuja ngapi? Hiyo iko kwa swali. Angalia note number 9. The capital structure of the company comprises 15% debt, 40% preferred shares, and 45% equity. Equity and retained earnings are the same. Sawa. Equity and retained earnings are the same. So how much is that? Nakuja ngapi? 30 million. So in other words, if the company has a project between 1 shilling and 30 million, it's going to use what? Retained earnings. In case the project now 30 million, they're going to go to the next cheapest, which is bank loan. So they told us to do which one and which one? Bank loan na gani ingine? Debt bank loan, ndio? Tumeelewana? Sorry. Retained earning and equity are the same thing. This one. Here difference. Preference is also, no, preference is, that is different. Yeah. The next cheapest one is bank loan. It's easier to go for bank loan than preference shares. Because when you're issuing shares, imagine you have to incur cost to advertise for people to know that you're issuing shares, isn't it? If you walk to a bank, you only discuss with the bank manager, the next day you have money. Which one is cheaper than the other? But you have to pay interest, but now getting that loan, which one is cheaper? Where getting finances through shares, even people will not, you are not sure if the people are going to subscribe, isn't it? So it is cheaper. Retained earnings, you already have the money with you, isn't it? From the profit. Then the next cheaper is bank loan, isn't it? So you don't incur a lot of cost to get a bank loan. So long as you have a healthy balance sheet, you are given funds, isn't it? Tumeelewana? So they want the break point, debt, that is number 1. Then the debt, that is loan. Tumeelewana? So they have available bank loan of how much? Bank loan available. Bank loan available over proportion of bank loans, proportion of bank loan. So bank loan available in ngapi? So 24 million, isn't it? 24 million. The proportion of the bank loan? 0.15. So it means $160. So 160 million. So in other words, if they have a project that exceeds 30 million and does not go beyond 160 million, so they're going to use bank loan. Any project that exceeds 160 million, they're going to go to the next cheapest. Which is the next cheapest? The bond, isn't it? So that is how they're going to go. Tumeelewana? We understand what is breakpoint, isn't it? Now they want the MCC in breakpoint. That is 4 marks. Just doing this, you get 4 marks. And then the last thing is they want the MCC in breakpoints. MCC in breakpoints. So the first breakpoint is between a range. The first range here is between 0 and 30 million. Supposing they have a project that ranges between that, isn't it? So they want to know the weighted average cost of car between 0 and 30 million, isn't it? So between 0 and 30 million, they're going to use the retained earnings. They're going to use the retained earnings. So the retained earnings and cost of equity, we say they are the same together, isn't it? So we're going to pick this, isn't it? And of course, the capital structure must be complete, 200%, isn't it? So here we're going to use the retained earnings, isn't it? So here we're going to write source. And then here we have the cost. And then cost times proportion. So here we're going to have the retained earnings. Nikiandika hiyo tutakuwa na shida. RE stands for retained. So the proportion is how much? 0.45. Is it so? And then the cost is how much? 13.5. And then we're going to have what? Preference share capital. Preference share capital. Proportion ni ngapi? 0.4. Alafu hapa tutakuwa na loan. Hizi zimekuwa ngapi? Tutakuwa na loan hapa, si ndio? 0.15. So itakuja 100. Cost ya hii ni ngapi? Unaona hapa, so why are we picking loan not bond? Loan and bond are the same, isn't it? So here we're looking at the cheaper. So tumesema loan is cheaper than the bond, si ndio? At this level tutachukua nini? Loan. Here tuna option mbili. Tunaweza choose equity and retained earnings, but we're looking at the cheaper, isn't it? So the cheaper is what? So it will take that proportion of the equity, isn't it? Understood? You have an issue? No? The preference. Preference is it is independent. No, yeah, we are now here, we are combining, we want to know the total cost, combined cost, in case we are contributing between 0 and, we have a project that runs between 0 shillings and 30 million, isn't it? So this one must be combined. We are using retained earnings, isn't it? But we have to have a combined, this proportion must equate to 100, isn't it? It must aggregate to 100. Then we are saying retained earnings, we have two options, either retained earnings and equity. So now we are looking at the cheaper first. So the cheaper at this point is retained earnings. Preference shares, we don't have options, so we just take it the way it is. Are we together? Loan and bond. Loan is cheaper at this point, isn't it? So it will represent the 0.15. So 13.5, this other one is 11.4. This other one, 8 point. Oh, that is the bond, isn't it? This is 7, isn't it? So when you multiply this one, unapata ngapi? Sorry? 6.075. This other one? 4.5. Huh? 4.58. This other one? 1.05, isn't it? Total inakuja ngapi? 11.7, sindio? So range ya pili, the range between 160 million, 30 million and 160. So hapo tutasema source, proportion, and then cost. Na hii ni cost times proportion. So hapa tujua retained earning iko exhausted, si ndio? So the source itakuwa nini? KE. Si kweli? Tutaenda kwa equity, si ndio? Lakini jua hii inakuwa sponsored na nini? Na bank loan. Is it so? But we have to have the composition equating to 100. So here we're going to go to retained earnings. Yeah, sorry, ordinary share capital or common shares. Proportion yake itakuwa 0.45. Cost yake ni ngapi? 14.3. Hapa tutakuwa na nini? Preference share capital. Proportion yake ni ngapi? 0.4. Alafu hapa itakuwa 11.45. Hapa tuna loan, si ndio? Which is 0.15. Na hapa 7. So ukimultiply unapata ngapi? 6.435. Na hii 4.55. 58. Na hapa 1.0 total 12.06, and then above 160, the last one is above 160 million. So we're saying we're going to use the bond, isn't it? So here we're going to write the source, proportion, cost times proportion. So the source is going to be ordinary share capital, is it so? Which is 0.45, 14.3. And then we have preference share capital, which is 0.4, and then 11.45. And then here we're going to use the bond. Is it so? The bond, what is the proportion? 0.1, 0.15, and the cost is 8. So here when we multiply, it's going to be 6.435, and this one is 4. The last one, $1.35. Hadi unapata ngapi? Eh? 12.3%, isn't it? So iko hivyo. That is how we do that question ya MCC breakpoint. Sijui kama mmeelewa. So this question was stated in September 2021. The total marks was 14 marks. So they wanted you to compute the component cost of capital and then the breakpoint in relation to retained earnings and loan, and then you come with that. Sijui kama tumeelewa. Kwa sawa? Yeah. So I don't know whether we still have time so that we can do one more question. So there are several questions on weighted average cost of capital, MCC. Even in your handouts, we have several other questions that have been done. So I think we have some time. We can do one more question, isn't it? May 2012, question number 2A. Can I do this one? May 2012. So the question reads, are we there? Roku Limited is planning to issue 10 million 0.25 shares with the current market price of 1.5 come dividend. Come dividend means with the dividend. So the market price is with the dividend. An annual dividend of 0.09 has been proposed. The company earns an accounting rate of return on equity of 10%, a dividend payout ratio of 40%. So the company also has 13%, 100 redeemable debentures with a nominal value of 7 million trading at 105. The debentures are due to be redeemed at par value in 5 years' time. Assume a corporation tax rate of 30% required. Weighted average cost of capital work, max 10, isn't it? So the first thing is component cost of capital. Cost of, that is number one. So we compute the component cost of, so here we have only two items. We have ordinary shares and debentures. Si ni kweli? Hatuna preference shares. So we have, so tunaangalia. So we said for us to determine the cost of equity, when you are computing for weighted average cost of capital, always there's no retained earnings. Is it so? So we check the kind of dividend given. An annual dividend rate has been proposed. That one is it future or past? Huh? Proposed on what? On the already happened, sindio? Ama imeproposiwa juu ya nini? Si proposal inakuanga kwa zile vitu zishafanyika. Huh? When you are proposing dividend on what? On what has already happened, isn't it? So there's expected dividend and there's proposed dividend. Are they the same? The expected dividend and the proposed dividend, are they the same? Proposed is based on what has already happened, isn't it? This is what we've earned and this is what we are proposing to pay, isn't it? And then this is what we expect in the future, isn't it? So that one is already on, that is DO, according to me. According? That one is, it is on profit that have already been generated, isn't it? So it's the dividend on past profits, isn't it? So for future, it must we expect. Expect. So this one we're going to use DO 1 plus G. So first of all, write the formula and then identify the variables. That is the procedure. Write the formula and identify the variables. So the formula we know. So we have the shares. The share is 0.09. So the PO, this PO must X div. The market price must be X div. So cum div means inclusive of the dividend. So the market price inclusive of dividend is equals to 1.55. Is it so? And then we minus 0.09. So what is the market price? Without dividend. Zero? 1.46. 1.4. This is the PO. And then we don't have the G. We don't have we say we use the retention ratio. The variables that we have been given here to assist us compute the G, we have the return on equity and the RB. So RB, return on equity, and then retention ratio. So return on equity is 10%, 10%. And then they have a payout ratio of how much? 40. So the retention ratio is how much? 60%. So the return on equity is 10%. The payout ratio is 40. So therefore, the retention ratio is how much? 60. So the G will be how much? Wanna leap out dividend here 40%, isn't it? So they are paying out a dividend of 40. That is the payout ratio. So they are retaining how much? 60. So how much will that be? 0.0 or 6%. So we have everything. Is it so? So we come here and compute our DO, which is 0.09 in bracket 1 plus 0.06 over 1.46 plus 0.06. And then here we multiply by 100. So what do you get? Sorry? 12.53%. And then we go and compute the KD, because we have only two components. So the cost of debentures. So this, the kind of debentures given here is it redeemable or irredeemable? Redeemable. So we write the formula, interest plus 1 over n in bracket MD minus VD over a half MD minus plus, VD 1 minus T. So the interest we said is based on the par value, isn't it? The company has 13%, 100 redeemable debentures with a nominal value of 7 million, trading at 105. So this is going to be 13% of 100, the par value, isn't it? Plus 1 over, what is the redeemable value, the time? N is 5, isn't it? MD is how much? 100, isn't it? Minus 105, is it so? Then here half in bracket 100 plus, then 1 minus 0.3. So ukicompute hiyo unapata ngapi? 8 point. So this is going to be 8.2%. And then we come here and get the market value. Market value of the component. We get the market values. So we have the ordinary share capital. So the company is planning to issue how many shares? 10. So you can write here 10 million or 10M, and then you multiply by 1.46. Is it so? And then here we have debentures. How many debentures? The nominal value of the debenture is 7 million. The company has also 100 redeemable debentures. The nominal value of 7 million, which is 7,000, divided by 100, isn't it? And then you multiply by 105, isn't it? Nominal value means the book value, is it so? Plus the par value. So the total par value, 7 million divided by, so how much you get here? 146, 100, 14600, This other one? 70? 7350. So here we say source, value, proportion, cost, and then cost times proportion. So the value is ordinary share capital, 14,600, debentures, 7350 total. $21,950. So 14,600 divided by 21,950, what is the proportion? 0.665. Na hiyo ingine? Eh? 0.3? 0.335. Then when your mod cost here is 12.5. And here 8.2. When you multiply, what do you get? 8.31. And this other one? 2.75. Then you add this one. Weighted average cost of capital. How much is that? %11. So that brings to the end of that question. Sawa. So kuna swali mingi. Every sitting lazima hii swali ikuje. So your work, you attempt any question. In case you have issues, please, you can consult, isn't it? That is the procedure. Now, every sitting has this question. Ukiangalia lazima uone weighted average cost of capital, uangalie. So for instance, May 2021, kuna swali ya work, weighted average cost of capital, May 2021. When you check November 2020, the question that the exam, there is also a question on weighted average cost of capital. So May 2019, there's a question on weighted average cost of capital. So they are there every sitting, so attempt, and then you let us know. Is that okay? So now we come to an end of our session today. Until next time.